Hi and welcome back. In this lesson we're going to be learning about selling stock short. You know, a lot of people are afraid of selling stock short. It's got kind of a bad connotation to it, but there's really no reason we should be. Selling short is a very practical way of trading the market, and it's a very important function in terms of the market. So let's understand selling stock short a little bit better. When we talk about selling stock short, you need to understand that selling stock short is basically the opposite of what you would do when you buy a stock long. That is the simplest way to understand short. Short is the opposite of long if you're talking about length, and if we're talking about trade types, a short trade is the opposite of a long trade. To initiate a short trade, we're going to sell a stock. And whenever we sell that stock, we've taken now a short position in that stock. Now, how do you sell a stock you don't own? And the answer is you borrow it. So we borrow some shares that we don't own, and then we go out and we sell them on the open market. Now the challenge with this is at some point you're going to have to come back and eventually buy to cover those shares. You can't be short forever. And so we're going to borrow some shares, we're going to sell them, and at some point you have to come back and buy them. Now the question that often comes up is, how much time do I have to buy to cover my position? And the answer is technically as much time as you want. There is no limit that you have to specifically fill. The only thing you need to be aware of is that you will be racking up some interest charges. So typically what that's going to look like is it's going to look like a 6 or 7% interest rate over the course of a year. So let's say that you were short some shares for an entire year. Well, at the end of that year, you would have accumulated about a 6 or 7% interest rate. Now, most of the time, you're actually only going to be in a short position for a few days, maybe up to a few weeks. And so the interest rates will be relatively nominal compared to the profit that hopefully you're making on the trade itself. But you do need to know that whenever you short, you're going to have some interest charged, all right? Now, with that in mind, here's the other downside of selling stock short. You don't receive dividends because you borrowed the shares, you're going to owe the shares, and you're going to be responsible for any dividends that may be required during that particular trade. Now, this may not be an issue. Not all stocks trade dividends or pay dividends, so there may be nothing there. Or if you avoid shorting during dividend season, then you won't have an issue with that as well. So the dividends aren't really a big obstacle to selling short, but if you are short over a dividend payout, then you're going to be required to compensate for that. And the final thing you need to understand about selling stock short is you need for the stock to go down. When we sell short, it is a bearish trade. We're only going to make money if the stock is decreasing in value. So with that as an understanding, let's come over here and let's look at a trade. This is a Netflix trade that was a pretty popular trade we did back in 2011. And if you look at this trade, you're going to notice that, hey, this trend's been going bullish for quite some time. We've been bouncing up off of our support levels here. But just recently, we've broken down below our support. And so we've got one more level of horizontal support coming in at 250, and we put a trigger in here that says, you know, if Netflix trades below this price point, well, then I'm going to sell the stock short. So let's see what happens with this trade. Well, sure enough, a couple days later, the stock does trade below that price point, and we get into this short trade around maybe 240, 245 a share. As the trade starts to sell off, look what happened. Watch the trading behavior. We sold off to support, we bounced back up to resistance, and we continued the sell-off. This is a very typical pattern. As we learn more about patterns moving forward, you're going to learn that this is a very, very typical pattern in a reversal formation where the stock breaks through support, trades straight to the next support, bounces back up to test the previous support as a new resistance. But in terms of this trade and where we're going, where do we get out? Well, we get out after we hit our second level support, and we bounced, and then we came back down. You could get out either time we hit this support down here around $205 a share. So let's see what happened here with Netflix. If we look at our balance sheet, notice in our cash column, we started off with a balance of $41,200. Now we decided to go sell stock short, and we're going to go sell 100 shares of Netflix at $245. That brings in $24,500. Now, let's think about this. Remember from the last lesson, whenever we sell stock, cash comes into our account and stock goes out. So look what happened at the same time. The cash came in of $24,500, but look at the number of shares. The shares went out. We shorted, we sold short, we got rid of 100 shares at $245. So if we look at our equity position is now negative $24,500. Now, look at your total account balance here. It has not changed. We went from $41,200 to $41,200. So all we've done is we've played a little shuffle. We exchanged some shares that we didn't have. We took a negative share position of $24,500. That turned into cash in our account. The equity is negative. The cash, or the total balance, account balance, is now $41,200. Okay? Now, let's come on down to the next line. You see that the $24,000 has been added in. We've now got a new balance of $65,700. We've got a negative share position and a negative equity position. And when we complete the trade and we finally buy the stock, we ended up doing that at $205 a share. So look what happened here. We buy to cover. Remember, when we buy shares, what happens? Shares come into the account and cash goes out. So in this case, we're going to be buying 100 shares of Netflix at $205 a share. Look, at our cash, we're losing $20,500. Not losing it, but we're getting rid of it. And that lowers our cash position down to $45,200. But look over here at the number of shares. We're adding 100 shares, and that brings our total share value to 0. If you come over another column, the equity position that was negative has now increased by $20,500, and our new account balance is $45,200. So we've added $4,000 of value by doing this trade. Again, what we did is we sold while the stock was high, and we buy to cover when the stock has decreased in price. So the reason I went through this is I want you to understand the flow of cash and shares. Whenever we buy, the shares come into the account, the cash goes out, but when we sell short, the shares go out of the account, even if you don't have them, and the cash comes into the account. And that's what you see has taken place in this particular screen. Now let's talk about selling short and understanding it a little bit better. Whenever we sell short, you're short because you don't own the stock. You owe the stock instead of owning it. Remember, whenever we buy a stock, we own it, but when we short a stock, we do not own it. Instead, we owe it. We've borrowed it. You say, well, how can you possibly sell something that we don't own? And the answer is, well, it's the rules of the game. And so the way we're going to do is we're going to borrow it, and then we're going to turn around, and we're going to sell those positions. So now that we understand the flow of funds a little bit better, in the next section, we're going to talk about how short selling actually works and why it works and why it's so important in the market.